Okay, let's go ahead and get started for tonight. As always, there's more things to cover than there is necessarily time to cover, but we do what we can. In terms of agenda tonight, I would like, if possible, to get through local equity participation, tax-effective locations, and the general anti-avoidance rule. And if we're really fast, which I doubt, maybe also transfer pricing. In any case, the last 40 or 50 minutes of the class will talk about the ABC case study factual pattern and the questions and answers which you received, I think it was on Saturday. I don't know whether you had a chance to read through. Hopefully you had a chance to at least scan, but we'll try to talk through them and see what questions you have as to what it actually means and what's there. First, starting off on local equity participation. Well, what do we mean by local equity participation? Well, some number of countries have internal policies which require some amount of local ownership of operations. So if we have our typical situation of X over here from country A, and it wants to do something within country B, country B may have local rules which say, if you want to conduct this business, there has to be some minimum percentage of local participation, or there has to be local control for this particular area of business. And as a result, in general, some sort of entity must be formed that X will own partially, whether below 50%, whether 50% or above, and some local parties, be they individuals or be they companies, will have an ownership interest. So we have this kind of situation. Local laws requiring some equity participation by local residents, local companies in country B. Do we find this often? Well, it's hit and miss. Some countries have a great tradition of it. If you know anything about Malaysia, they have had what is called a Bumi-Putra policy for many, many years. And that's essentially the Bumi-Putra, the sons of the soil. They have been, so to speak, downtrodden and as a result need help to come up. Now, maybe it's a political and social question as to whether this has actually helped anybody other than the Bumi-Putra who are already wealthy, but that's another issue. In any case, Malaysia's quite well known for this. Now, China actually has quite a bit of this also, but it's not from the standpoint of thinking that certain segments of the Chinese population are maybe not adequately part of society and part of the economic well-being, but rather it's that on an industry-by-industry basis, China says, we don't want, for certain activities, foreigners to have control. Or we want at least some local participation in certain types of projects. One that comes to mind is land development. If you're doing certain types of land development, you need Chinese participation. So you see this kind of thing. And in fact, again, if anybody is specifically interested in China, let me know and I'll distribute the foreign investment catalog, which shows these things. Yes, Jasmine?
Professor, is there an approval requirement as well?
Is there what?
An approval requirement from government agency?
I'm sorry, is there a what requirement?
Approval requirement?
Oh, approval requirement. Well, again, it depends on country, but in general, there are mechanisms for approvals of foreign investment in a lot of countries. Japan, for example, still has a specific, not only a rule on the approval of foreign investment, but even still has the mechanism for exchange controls, although as a practical matter, they're really very lightly applied now. China has a very strong investment approval. Most countries will have something along that line. Needless to say, perhaps, if you're going to have a local equity component, then as a practical matter, you pretty much are forced into using some sort of local legal entity so that there is a vehicle which the local party can have an interest in. Now, when you get to your ABC case study, if you're choosing a country where you find that maybe a local equity partner is an absolute necessity, otherwise they cannot do business in that country, then this will affect what sort of structure you choose. Notice I'm listing two different types of local equity participation: real and mere nominee. Well, what do we mean by that? Real is you're actually getting somebody as a partner. I speak of partner not in the legal sense of there being a partnership with several partners, but rather a partner in the general sense that he's going to be somehow involved in the business you're going to conduct. Really a strategic partner. You're looking for somebody who will in fact bring something to the table, whether it's local knowledge of the markets, whether it's local knowledge of the particular business, whether it's government contacts, which help you get a license or help you open up distribution channels or something. A real partner can bring something to the table. On the other hand, there's some number of countries, of course, where this is forced, and certainly Indonesia and Malaysia are probably the best examples of this that I know of, and that's where the local partner ends up being, maybe as a practical matter, a mere nominee. You need to have somebody who has the proper citizenship or local registration, but is he a real partner in a business sense? And the answer, in some cases, is going to be no. Now, notice along the bottom, if you're getting somebody who's a mere nominee, well, it'll often be the case that he really is happy to be there and put his name down, but he may or may not have his own money to put in. And in a lot of cases, I should say it this way, even if he does have money to put in, he may say, hey, I don't want to put my own money in, you loan me the money that I'm going to put in your company for my equity share. So when you have a nominee, you're creating a structure of maybe a loan to give him the funds. You're then concerned, well, maybe local law has certain minority rights. Let's say he has a 30% interest. And you want to protect yourself in case he tries to exercise those minority rights. So maybe you have a transfer, a blank signed transfer in place where you fill in the date if he does something you don't want him to do. In other words, when there's a nominee situation, you have to create, in a way, a lot of paperwork and a structure that will protect yourself. And this is not something that's great to have to deal with, because not only does it create various risks, it also brings up a question of, if the government ever does come in and looks at all of these items, are they evidence of you as a company doing something which is so obviously against the intent of the rules in the first place? So there's some, in a sense, business and reputational risk from getting into these sorts of things. Also in the home country, how do you treat this nominee situation in the home country? If you had a nominee that owned in legal form exactly 50%, for example, would you voluntarily say, gee, this is a controlled foreign corporation because we really do have legal control over it? Well, maybe you'd decide to do so, but it's something you have to be thinking about and make a decision on. And whenever you make a corporate decision, in a sense which is contrary to what you really are supposed to be doing under the intent and the language of the law in another country, if there's an inconsistency, that's not necessarily so comfortable for directors of the company to be seeing. Inconsistency in terms of how, the position you take versus the position you're taking in another country that you're meeting the local equity rules. So this can be an area that gives some discomfort. Tax-effective locations. This is a term which I came up with simply to try to come up with an expression which gets to the intent, but which doesn't have, let's say, a bad connotation to it. Now, perhaps to you, Marissa, the word tax haven has a good connotation, I don't know. But irrespective, around the world, tax haven has a certain, let's say, bad flavor for a lot of people, and certainly a lot of tax authorities. So, in terms of our discussing this broader term, I think is appropriate because there are legitimate uses of tax-effective locations. There are perhaps illegitimate uses of tax-effective locations. And trying to understand how to allow your clients or the companies that you work for to, in fact, use a tax-effective location in a legitimate manner, and why conceptually it's, let's say, ethical, and you can feel good about advising the use of them in certain situations, is something that we want to get across. Now, when I originally was putting this course together, I spent a reasonable amount of time trying to figure out how to present this area of tax-effective locations. And the reason I say that is because if you look into the various, let's say, source material for tax havens or for related topics, the usual thing you find is, okay, there are X number of tax havens in the world, and this is how we define a tax haven. And for example, maybe you'll look specifically at the Cayman Islands and what are its characteristics and so on. So rather than focus on that, which number one is available to you, very available to you through your research sources, how they're used and then trying to organize it in some rational fashion so that the area becomes hopefully more manageable. So what I would ask of you is, we'll go through the material here. Please take a look back in the next week, especially in the overview material where there's discussion of this. And then next week, if you've got some further questions or you want to cement some understanding, please bring it up, because this area of legitimately using tax-effective locations is an important part of international tax planning. Structurally, we're going to talk about this first with regard to the tax-effective location being the home country. Secondly, what if it's not the home country, but the source country or host country where some business activities take place? Or thirdly, which is what a lot of people think of in this area, and that's the intermediary company, which is in the middle between the home country and the country of operation. Home country, taking that one first. There's a reasonable number of examples out there of where where a business is, let's say, being newly formed. And we, of course, I think, here in the U.S., which is a very large country and where a lot of our business that we're going to conduct is domestic business, we generally just sort of automatically say, gee, if we're going to start up a business, or if our client is going to start up a business, then, gee, we should form a Washington LLC, or a Washington corporation, or a Delaware corporation, or a Nevada corporation, or whatever it is that we think is appropriate. But let's say your client comes to you and says, well, gee, I'm going to be doing a lot of business, of course, here locally, but a lot of my business also is going to be in some number, one or more countries overseas somewhere. Well, it's a legitimate question to ask, should I have a holding company, in a sense, that's going to own the operations, let's say all of this business? Should I have that company formed in the United States? Should I have that company formed somewhere else? And then maybe there's a subsidiary which will operate in the United States, and a subsidiary that will operate somewhere else. Now, depending on the situation, you might find, gee, that gives you a better answer. Other situations, it might be a terrible answer. But the point is, when you form something, you have a choice. Where is that new company which is going to be formed? Where will it be? Where will it be formed? Under what country's laws? Now, let me give a couple of short examples of this through a case study approach. The first one, if I remember correctly, this was a situation where we were doing work in China for a client. And the situation was that there was a plan for a joint venture. One party was a U.S. party, and the other party was Taiwanese. And they were going to have a joint venture to distribute, as I recall, sunglasses. One side provided the frames, one side provided the lenses. They put them together, and the idea was that this company here, joint venture, would distribute in China. When I read the agreement, the joint venture agreement between them, in other words, they came in the door and they already had a signed joint venture agreement as to how they were going to conduct the business. And they said in the agreement, and if this joint venture is successful, if it's successful in China, then we will roll it out to other countries in Asia. If it's successful, we'll roll it out to other countries in Asia. Now, the thinking about this was that the joint venture would be a Chinese company because the distribution was going to be in China. The assembly of the frames and the lenses was going to be in a company in China, which was a subsidiary of the Taiwanese company. That was the company that was going to put them together. So in everybody's mind, it's China. Why would you ever want to put it somewhere else? But in looking at this, saying this will hopefully be successful, and what they're telling us is that this joint venture might later want to have subsidiaries in other Asian countries. Maybe Philippines, maybe Malaysia, maybe Australia, other places. Now, one thing that you might say is, well, of course, the two parties, the U.S. company and the Taiwanese company, they, of course, could choose, if they wanted, to not make the future expansion as subsidiaries of this joint venture. They don't have to put them down here. They could be owned directly from the venturers. And of course, that's absolutely right. And that would solve the problem, which I'll raise in a moment. But there is something that I would call human nature with respect to joint ventures. And that is that a joint venture that is a real joint venture takes on a life of its own. The management of the joint venture might know they have two parents, so to speak, to report to, two parents to answer to. But if it really is a joint venture, especially like this one where it was specifically 50-50, and neither party has control, the management is really now a new company. This is in a sense, the management is thinking of themselves as a new company. They're not a subsidiary of somebody else. You have created a new life, a new entity which can grow on its own, a new management. And that new management is going to want to have control over expansion into Asia. They're going to be very, very strong that any future expansion is going to be under them and not missing them. So, as a result of this, knowing that we want to try to today avoid a problem tomorrow, we have to ask, well, what entity should this joint venture be? Should we say specifically that it must not be Chinese, but rather it should be somewhere else? Now, I don't want to right now go into where that somewhere else might be, but it would be a country, it would be a place of incorporation which allows, on the one hand, a management structure, a decision-making structure that could itself, of course, have a Chinese subsidiary, and which could also have subsidiaries in the Philippines, in Malaysia, in Australia, and elsewhere. Now, why was it so necessary to not have the holding company in China? Why is it so important that we put this X through the Chinese location of formation? Does anybody remember what I said either last week or some earlier week about what happens when you have an investor from one country, a U.S. company, and then an investment, a subsidiary of that U.S. company outside of the U.S.? Anybody recall why I said that was something you normally want to avoid? Parent company, U.S. company, subsidiary outside the U.S. Parent company outside the U.S., subsidiary outside, company in the middle in the U.S. Why is that normally something you don't want to do?
Taxable worldwide income? Like it'll draw in those foreign ones?
Well, yeah, right. That by putting the U.S. in the middle, there's an extra layer of tax. If you just had ownership from the parent to the subsidiary outside the U.S., you would avoid a 35% tax, less any foreign tax credit, and you would also avoid a 30% withholding tax, or lowered by treaty rate, on dividends. So you want to avoid having a U.S. company in the middle. Well, the same thing is true for China. Except in China, it's a 25% tax as reduced by a foreign tax credit. And then it's a 10% withholding tax out. So the point is, you don't want to put a country like China or the U.S. in the middle. And as a result, in this case, after some reasonable amount of educating the client, and this was not easy, but eventually the two parties agreed, yeah, because of their hope that they would expand this business, the joint venture entity should be a company which is not in China. Should be somewhere else in a tax-effective location that doesn't add another layer of tax like China or the U.S. does. Yes, Peter?
Is it a So the situation with America isn't that bad because there's taxation on worldwide income? That's one of the reasons why it's bad.
Well, it's not only, I mean, you're right, it's a combination of worldwide income taxation, less foreign tax credit, plus withholding tax on dividends going out. So if you were to give...
The reason I asked that is because in China, do they have taxation on worldwide income?
Yeah, absolutely.
Oh, okay.
Absolutely.
All right.
You have in the course website a booklet which has a nice English language translation of the Chinese tax law. And it's very nice and simple, and yes, worldwide income taxation with a foreign tax credit mechanism. It's very short and sweet, and is a lot easier to read than your U.S. tax law, but it's exactly the same. Has anybody ever heard of Accenture? Andrew, you're nodding your head like you've heard of it, so what is it?
Wasn't it formerly Arthur Anderson's consulting firm, and they got spun off before? I think they just do consulting stuff now.
Well, I think, well, you're absolutely right. It was formerly part of the Anderson Worldwide Organization, where I think you might get some differences of opinion in terms of word usage is whether it was spun off or whether it escaped. So there's a difference there. But in any case, having said that, if we say what was before it escaped, what did the organization look like? The Anderson organization, like the other large accounting firms and a few law firms, was owned, was in a sense structured as many, what I guess I would call brother-sister companies, but each company was owned by its local partners. In some cases, these were legally partnerships. In some cases, these were corporations. But the structure basically looked like this. And it made sense from a tax point of view because essentially the operations in each country and the net income in each country was taxable to the owners in that country. And you did not have, for the most part, taxation of operating income by more than one country. You did not have taxation of operating income by more than one country. So this was tax efficient. Now, you might say, well, gee, wasn't it like one worldwide organization with one management? And the answer is yes, it was. There's more than one way to get management in a number of entities. They can all have one agreement that they all are signed on to, an inter-firm operating agreement, so to speak, which has provisions as to how they will work together, how they will use the technology of each other, how they will operate as a single unit. And in fact, even though this was the legal structure, there was one clear worldwide management through these operating agreements, through these inter-firm agreements. Now, shortly after Anderson Consulting escaped from Arthur Anderson, or was spun off, whichever term you wish to use, they went through an initial public offering, went through an IPO. Now, if you're going to go through an IPO, would you use this kind of structure? Could you have all these separate companies go through an initial public offering? You really can't. You have to have a parent company, one company that's going to list. So as a result, and I will not right now go through how it was done, but essentially they went through a reorganization. And at the time, as I recall, I think they were doing business in around 40 different countries, give or take a few. They reorganized so that all of these companies became subsidiaries of one new holding company. And of course, the owners of this new holding company were the people, the partners who had previously owned legally just their piece. So a new holding company was created. Well, the obvious question is, where should we put this new holding company? This is going to be, this is going to go through an IPO in the U.S. Does that new holding company have to be a U.S. company? And if it were, what would the consequence be? Right now, remember, the owners of this thing, that before the IPO, the owners of 100% of this are the former partners. And probably, I'm guessing on this, but probably 60 or 70% at least of the former partners were from countries all around the world. If the holding company were a U.S. company, all of a sudden you'd be adding a layer of U.S. tax to what economically will be earned by those shareholders who are outside the United States. So using a U.S. company as the holding company was really a non-starter. Really a non-starter. You just would not want to do that. So what did they do? As it turned out, they made this a company formed in Bermuda. Bermuda would not tax any income that comes through. So as a result, to the extent that the operating companies have income and pay dividends up, there's no taxation in Bermuda. And further, there's no taxation of dividends that there's no taxation of dividends that the holding company might pay to shareholders, whether they're in the U.S. or whether they're outside the U.S. So, again, you have taxation of the actual operations, and you potentially have taxation in the country of residence of the shareholder, but you have no taxation in the main holding company. There's no tax cost in terms of flowing the dividends up to the individual shareholders. There's no tax cost anywhere except the actual country of operation and the country of residence of the shareholder. Now, this is a legitimate use of a tax-effective location. Is there any law that says, well, gee, we have to put this in the United States because some of the management people are in the United States and thereby create an extra layer of tax? There's no responsibility to form this company, this new holding company, under U.S. law. So this is a good example of this issue of using a tax-effective location for the home country of something. Now let's go to the host or source country. This is, I think, the easier one because we've spoken quite a bit about governmental incentives, and generally someplace that is a tax-efficient location from the standpoint of host or source country has incentives or a lack of tax specifically to encourage investment. So as a result, let's say you're going to form a new operation in Asia. Let's say you're a software company and you know that you've developed software in, let's say, in one country. You've written the software, tested it in one country, but now you need to put the software onto CDs or DVDs and then put it inside a box, often called a shrink wrap box, and then distribute those boxes to a number of countries. Well, the actual burning of the CDs or DVDs with the software and putting them into a nice printed box with cellophane around it, that's not exactly a high-tech aspect. But it really is the assembly, and perhaps you'd even call it manufacturing, of a product. Well, that particular kind of thing, you can choose, perhaps, do I want to put that and have it done in Malaysia? Do I want to have that done in China? Well, probably not, considering how quickly software and movies and things are sold on the street. But maybe even before you think about this, the software is already being sold there. But that's another story. The point is, in a case like this, you really have quite an ability to decide which country to do it in. The differences of wage rates maybe doesn't make a lot of difference to you. But the tax result might well be very important to you as to which country. And if you find one that gives you a tax holiday for doing this, let's say, high-tech look-alike thing locally, then maybe that's something that saves a lot of money. Let's move into the intermediate country area. Now, whenever we talk about groups of companies, we will see a number of flows that will exist between the companies. And these flows exist because there's business being conducted. Something is needed here that is coming from somewhere else, whether it's invested capital, whether it's technology, whether it's equipment. So you have flows that, as a practical matter, are there. Now, if we draw some sort of picture, we can, on the picture, point out what some of the flows are, so that we, let's say, more visually see them. Now, let's say that, okay, country A, this one is in country B, this one is in country C, this one is in country D. We can label some flows. Now, we said that these are 3 subsidiaries. Okay, so one we said was invested capital. So maybe X has put funds into Y as invested capital. And that implies, number one, that there's a flow of funds in one way and potentially dividends going the other. X might also choose to make an intercompany loan so that there will be both interest and principal payments. Nothing too magic about this. Maybe X has certain patents, and maybe it licenses those patents here, so that as a result there's a stream of royalties. The source country will very often have some sort of withholding tax. You've been hearing about withholding tax since probably the first session of this class. They are common. You find them a lot. Now, what's one country with one of the highest withholding taxes there is?
US.
The U.S., yeah, absolutely. So let's pretend for a moment that D over here is in the U.S., and let's assume that X is maybe X is, let's say, from Hong Kong, and there's no tax treaty between Hong Kong and the U.S., so the domestic U.S. withholding rules apply. There's a 30% withholding tax on royalties going from D to, let's make this W. There's a withholding tax of 30% going from W to X. Now, that's obviously a terrible answer, having such a high thing. But would you have the same answer if you found some additional location? Okay, let's say we have X and W, and we decide that there's a country, let's say maybe the Netherlands, as an example, which has a tax treaty with the U.S. with a favorable withholding rate on royalty. Now, I'm not sure today what the withholding rate on royalty is under the current Dutch-U.S. treaty. I would guess it's either 5% or maybe 0 under certain circumstances. So the question is, can we in some way put a company in between that will, instead of licensing directly, will somehow be in the middle so that the license payments go here and are subject to a lower withholding tax. Now, here I'm talking about something that you can legitimately call treaty shopping. There's a number of treaties with reduced withholding tax rates. So can we put something in between and achieve a lower withholding tax? The U.S. is probably the worst example on this, or maybe it's the best example. On the surface, yes, we could put V in the middle. We could have X, for example, go ahead and license to V, and V then does a sublicense to W, and in legal form, we have a qualification, so to speak, for a lower income tax withholding on the royalty stream. We have the legal form for it. Will it be successful? Well, probably not, because the U.S. has so many, or let me rephrase it. The U.S. has been paranoid about treaty shopping, and starting, I don't know, 20 or 30 years ago, they started to attack situations where the benefits of a treaty were being inappropriately taken by somebody who really didn't qualify for the benefit. One of the earliest manifestations of that, which you may or may not have run into in your studies, is the Aiken case, which was a back-to-back loan arrangement. Let's say similar to a back-to-back licensing arrangement. And the court looked at it and said, well, the V in that case really is not the owner of the income, because they're just sort of in the middle there. They really don't have control over the flow of payments which is going to them. So they really don't. They're really not the earner of the royalty, or in that case, the interest. It's really the parent company above that is orchestrating all this. Now, the U.S. over a period of years has put into place conduit rules, which you can find in the regulations. It's negotiated in tax treaties, and we'll talk about this in detail more later, but what's called limitation on benefit rules, which basically tries to say that if a company like V here is not owned by residents of the Netherlands, then they're not going to be considered resident for purposes of the treaty. And there's a number of other things. Again, I think some of these things are in the overview that is your required reading. But the U.S. has been very successful, I think, at putting in place mechanisms to fight this kind of thing. Now, the U.S. has, but a lot of other countries have not. Or a lot of other countries have not yet woken up to the fact that they want to do something about this. Recently, in the past year and a half, China has woken up to this. Whereas previously, there was very blatant treaty shopping with China. In the last year and a half, there have been some, what I guess I would call public rulings. In China, they tend to be called circulars. But in any case, rulings of how a call it a substance over form approach, will be looked at to determine if V is really entitled to treaty benefits. Now, when I talk about legitimate use of treaties, or I'm sorry, of tax-effective locations in a treaty shopping situation, what I've explained so far in this example is a very blatant case. I've said that X set up V, or I don't know that I went into much detail yet, but what was in my mind, which I might not have said to you yet, was that V was set up specifically for this purpose and then entered into the license and the sub-license. But what if V is an already existing company that has its own business? What if V is in a business which is related to that technology? What if V, for example, through a cost-sharing agreement, and we'll talk a little bit later on as to what a cost-sharing agreement is, what if V actually has an economic ownership interest in that technology and originally funded it? What if V also has some local ownership? Very often in our discussion, I try to go from one end of the spectrum to the other to try to say, well, gee, what if the facts are different? And the point is, again, from the standpoint of how you need to be thinking and the process of working with international taxation, this is not a mentality of, gee, where can I find a country that will be effective for treaty shopping, but rather, how can I work, in a sense, getting the benefit of a treaty into the facts of the taxpayer situation that I have in front of me. And of course, you learn those facts by asking questions. And we keep talking over and over again about asking questions, and we'll do more of that tonight in talking about the questions and answers on the ABC case study. But the point is that real international tax planning can come out of your knowing the facts and fitting the situation, fitting the, let's say, fitting your answers, your conclusions, your recommendations to the facts that are in front of you. Now, if the facts happen to be that W is in a country that doesn't really care about treaty shopping, then fine, go ahead and treaty shop to your heart's content and be at this end of the spectrum. But more and more today, countries are getting concerned about it and being a bit more aggressive. And that brings up the point that this is a moving target. Today, maybe the country where W is really doesn't aggressively look at this issue, but tomorrow they will. I don't think anybody expected China to move with the speed that it did from being a country where they had extremely favorable treaties with use that word, tax havens. They had very, very, very beneficial treaties with Mauritius, with Barbados. Well, why would they have treaties in the first place with those places? Nobody from those that's legitimately from those countries is doing investments, but they had those treaties. And they're not old treaties that were negotiated 25 years ago. They're treaties that are, I believe in both cases, less than 10 years old. So, you know, if you really don't like treaty shopping, a country is not going to enter into a tax treaty with a known tax haven. So, and in fact, historically, the United States had a tax treaty with the Dutch, the Netherlands Antilles, with the Netherlands Antilles. And originally, up through sometime in the 80s, that country was used as a way of avoiding tax on interest, if I remember correctly, where, let's say, where investors were investing into various funds outside of the United States, and then the money was channeled into the United States. It'll be very similar to something we'll talk about a bit later, maybe not too much later, regarding the Indo-Foods case. And at some point, I think this was 84, or 85, the U.S. just arbitrarily said, hey, this is stupid that we have a tax treaty with a tax haven. We will unilaterally terminate the tax treaty. And at the time, that wreaked havoc in the financial community, just as the Indo-Foods case got everybody worried. This is something which is a moving target. This is changing over time. And countries which today may not care, tomorrow they may care. And it means in talking to clients, you have to let them know, okay, we're setting this up today, but we need to monitor it. It may change. And one of the nice things, at least in the area of tax treaties, is if the tax treaty itself changes, usually there will be some number of months between the announced change and the effective date of the change. So with that, you can do something. But you cannot necessarily do something if a country, for example, like China, changes its approach through announced circulars, which it then applies on a retroactive basis. So these things have to be monitored closely, where you're getting a benefit that might not be, let's say, properly there, but clearly, in a legal sense, it is there. I mentioned about characteristics, that's the thing that you can certainly find a lot of in published literature. There's no tax, no exchange controls. Notice this, simple to form local companies. Very important to have the infrastructure where you can easily get a corporation or a partnership or whatever vehicle it is you want to use and administer it. Notice down here, characteristics becoming less common, and that's lack of transparency and lack of effective exchange of information. Over the past year, the statistic, I think, from the OECD, because of the very big effort the OECD and some number of countries, especially France, have been making to encourage exchange of information and transparency. The figure that the OECD put out was that in the last year, 2009, there were roughly 300 information exchange agreements or amendments to existing treaties to update the information exchange clauses or articles made in the last year. So this is becoming a more seldom seen thing, in other words, where there is not some sort of potential exchange of information. we've talked, or my discussion so far has really focused on treaty shopping, but that's not the only potential motivation from a tax point of view that is common out there and used. And notice, okay, treaty shopping is focusing on a benefit of the source or host country, whereas deferral of home country taxation is using a intermediary company to reduce or at least defer home country taxation. So let's say the objective is different, but the use is still there. Notice changing the character of income for home country tax purposes. Okay, what do we mean by that? Let's say we have X, Y, and Z. In home country A, let's say that a dividend receives a more favorable tax treatment than interest income. Let's say that the goal is to provide a loan to Z down here with the thought that it's a great idea if we have an intercompany loan at the Z level that, number one, interest down here in country C, interest is deductible. Secondly, the loan provides a mechanism for repatriation of cash. So if we have a loan in place, we get a tax benefit of an interest deduction, and we get an easy ability to just reduce the principal on the loan by paying it off. So we can get extra cash that we have at the Z level out. So this is our situation, that at the X level, we want a dividend. At the Z level, we want an interest deduction and a loan agreement in place. So we could have X, for example, capitalize Y with additional equity. Now, Y could be an existing company, in which case we increase the equity of the existing company, or Y could be a new co. Could be either. So anyway, additional equity. And then Y could make a loan to Z using the funds that are brought in. Now remember, sanctity of separate legal entity. If we create valid entities, generally they are respected. If we create valid contractual relationships and we respect them, generally they are respected by others. So as a result, by putting Y in the middle, we have changed the character of a flow of funds. We have interest coming out, which is treated one way by country C. We have transformed it in country B within Y. In other words, Y has interest income. But when Y turns around and declares a dividend, goes through the proper paperwork to declare a dividend, there is legally a dividend paid by Y to X. We have changed the character of the income. The same could be true if X, for example, were to transfer technology to Y, the ownership of technology. And now Y licenses that technology to Z. Z pays royalties. Those royalties are transformed into dividends. This is a legitimate use of an intermediary company. And while, yes, there are approaches for attacking it, it's not seeking to get necessarily a benefit under a tax treaty. The issue is really characterization of the within C, where it's treated as interest, and at A, where it's treated as a dividend. Or should the tax authorities at both ends look at this and try to recharacterize it? And again, if the planning and the execution is done well, the chances of the character being changed is going to be pretty low. In other words, that you can be successful in doing something like this where it makes sense to do it. Mixing foreign tax credits. As you can imagine, if you have income, well, maybe, let me rephrase that. In the U.S., we have an overall, let's say, basket. We don't have that basket is not separated country by country. But some countries do have a country-by-country foreign tax credit limitation. So in other words, you would not be able to offset and utilize credits from, let's say, excess foreign tax credits from one country, and then you have low foreign source income in another country that is subject to a very low foreign tax. You're not able to directly mix the two, and as a result, use more foreign tax credits. But some countries, if you put a holding company in the middle, that is sometimes called a mixer company, you have dividends from one country that have been subjected to a high tax, whether direct or indirect, and then dividends from another company that are low taxed, direct and indirect, and they mix in the middle and become, at the parent level, when a dividend is paid to the parent, a mixed item that allows more utilization of foreign tax credits. So again, that's mentioned in the overview. It's something you see occasionally, but it's, again, another legitimate use of intermediary companies. There are a lot of non-tax motivations for using intermediary countries also. Now, totally independent of whether or not there's a tax benefit of using something. There can be a lot of business situations where it's appropriate to use one. And although we happen to be in a tax LLM program, again, your thinking and your development should be not just to be a technical tax guy who can answer questions, but knowledgeable of your clients' businesses and able to recognize and help them structure their activity from all this information you learn from them by asking questions and helping them with their business problems, which also have a tax component to it. So, if we look at a major company that has subsidiaries in a number of locations and they're thinking about putting, for example, a regional management in place somewhere, helping them decide where that management should be, how the legal structure of that whatever entity will house those management people, that might involve a tax-efficient location. There's among many, many major multinationals, centralized cash and foreign exchange management. Well, there needs to be a legal structure for it. Where do you put it? Are you going to put it in your highest tax country? Well, maybe, maybe not. But very often these things may be in a tax efficient location that also has outstanding banking facilities. Ownership and control of intellectual property. Now, we're going to talk eventually about a case study when we get to transfer pricing that involves intellectual property. Think about the ownership of intellectual property. Do you have to have people and activities to own something that's intangible? Can you choose pretty much where you want something owned that is intangible? Very often, yes, there's a lot of freedom and flexibility. And as a result, a lot of major multinationals do set up some sort of entity somewhere, maybe in the Netherlands because it has a wonderful treaty network, maybe elsewhere, to invest in and own technology. So a tax-effective location can be involved. Anybody ever heard of captive insurance? Let's speak just a moment about that, because I think that's a particularly interesting example. Let's say that you have a group. This group is, maybe it has 100 subsidiaries in 50 different countries. And right now, each subsidiary for its particular business is buying insurance. Property insurance, liability insurance, fire insurance, what have you. And there's a lot of money going out to insurance companies in various places. Now, a very large company probably knows that it's going to be hit by some problems, a fire in this plant, maybe a product liability case somewhere else. They figure, gee, probably every year there's going to be at least 2 or 3 instances of things that, we need insurance for. But of course, if we have 100 subsidiaries, we don't know which one of the subsidiaries or the parent company these problems will crop up in, which is why all of them need insurance. But we have to pay an awful lot of money to insurance companies. And insurance companies are not in this business for their kind hearts. They're making some level of profit on the insurance payments that are paid. They're, of course, hoping that their payouts are less than the premiums they take in. That's fine. Now, if this company we're talking about that has 100 subsidiaries says, well, gee, I know that I'm going to have 2 or 3 instances of this thing every year. Maybe some years I'll be lucky and there won't be too much. Maybe some years I'll have a little extra, in terms of liability. But maybe I want to self-insure. Why should I give all this profit to a bunch of other insurance companies when I could save that if I self-insure? So what some companies do, they set up a captive insurance company, often in Bermuda, because it has good insurance laws and also is relatively respected as a tax-efficient location with good, solid corporate governance rules and oversight. Another reason why Accenture located there. And now, instead of paying outside insurance companies, each one of the subsidiaries enters into its insurance contracts either directly or indirectly with the captive. Now, I say indirectly because in some number of countries, local insurance regulations will not allow a company that is not qualified within that country, an insurance company that is not qualified to do business within that jurisdiction, to cover risks. So maybe they do it indirectly through an insurer that then goes through reinsurance. But again, complicated, but the basic thing is the insurance is now at this captive level. If X up here says, well, gee, I don't mind self-insuring, but I don't want to do it 100%, there's an easy mechanism where the captive itself enters into reinsurance with some other insurance company. So there are some risks that are put off to other parties. Now, this is a very legitimate use of a tax-efficient location. Is there anything that says, gee, this captive has to conduct its business in a country with a high tax rate? You can choose wherever you want to put this thing. Now, obviously, if you have a country like the U.S. that likes to attack this kind of thing, your strength of how strong this will be might get down to questions like, well, gee, what employees does this insurance company have? Does it have in the location of formation or somewhere else real management who are making insurance, whatever decisions an insurance executive has to make? Are they acting like a real insurance company? So there's obviously because of the interrelated or the intercompany fact of this thing, there's intercompany pricing situations that you have to worry about, and the U.S. is trying to attack these things also. But it's a very legitimate approach to organizing and managing for a multinational insurance. So there are legitimate uses of tax-efficient locations.
How do you capitalize the insurance company who does that type of thing at first?
Well, when you, there has to be, for something that's going to really act as an insurance company, a reasonable amount of capital coming from the parent. X would invest, who knows, depending on what the facts are and what the size of the risks and so on. Maybe they would put $500 million into this thing as equity.
So this probably only happens with big companies then?
It's something that is, yeah, larger groups of companies, yeah. But, I mean, you can understand there's a real business need to, number one, manage insurance risks in a, or let's say manage business and casualty risks within a large organization, and to the extent that you want to centrally manage your insurance, to the extent you want to actually self-insure, you can have a mechanism for it. And it makes sense also because, again, you don't know which one of the companies is going to have the loss. You could self-insure by having no insurance at all and no captive insurance company at all. But then that would mean that if this company here was the one where there was the huge casualty or huge problem, there's no insurance for that one. And there's no mechanism for funding the reimbursement of the loss from the other subsidiaries and the parent. Look at this particular slide that talks about minimizing taxation in the intermediate country. Let's assume that we have a simple situation of X, Y, and Z. The focus of this part of the discussion is on minimizing tax in Y, which is the intermediary company. Now, if Y has a zero tax rate, then no tax on income that it earns, no tax on dividends it pays, no withholding tax on dividends it pays, or on interest, or on royalties, then you're sort of home free with regard to income tax. But of course, you have to look at also what administrative costs are there, what governmental fees are there, and so on, because that can vary some. But for a lot of these things, those sorts of items tend to be relatively nominal, but they can be, you do have to be aware of them. So with looking at Y, let's assume now that country B is not a tax haven with no internal taxes, but rather let's assume that country B is a real country with a real tax rate on net income. So what can be done? For example, the Netherlands is very often looked at as being a very useful tax efficient country, but it has a normal tax rate. If there's net income in the country, it will be subject to a certain amount of tax. And there's withholding tax on dividends going out of the Netherlands. So there can be quite a bit of tax. But what do you do to try to avoid it? So let's say, for example, that the goal of a situation is that X wants to provide technology and intellectual property to Z. Well, let's say that X capitalizes Y and has Y purchase the IP for 100. Now, that gives Y a tax basis in the intellectual property. Now, of course, X in country A is going to have taxable income from the sale. So, gee, that might not be such a good idea. But who knows? Maybe X has net operating losses that would otherwise expire. Maybe this is a good way to utilize some net operating losses, create some income. So Y now has IP with a basis of 100. Well, Y owns that, and now Y enters into a license agreement with Z, and there is a royalty stream. Now, that royalty stream, of course, is income here. Let's say that royalty stream in one taxable period, let's say, is 10. And because of the tax treaty between B and C, there's very low or zero withholding on the royalty. Now, against the 10, we're able to amortize that 100. So as a result, maybe in this year, 8 is the proper amortization. So we have net income of 2. So the income tax, ignoring any other possible expenses there might be, the income tax which is assessed is the tax rate in country B times 2 and not times 10. So we have created, at least in this kind of thing, some deductions within country B, within company Y. And those deductions reduce down to, hopefully, a manageable and acceptable level the amount of tax cost that we have in country B for doing this. Now, we're of course comparing things. Maybe let's say the actual tax cost, let's say there's a 25% tax cost, so the actual tax, let's say, in country B is 0.5, but if we had paid the royalty directly from Z to X, maybe the withholding tax on 10 was, withholding tax on the 10 of royalty would have been 20% or 2. So we're comparing 2 to 0.5, we have saved 1.5 of tax. In addition, maybe X is providing some services that benefit Y. Maybe we could arrange for a service fee, which is legitimate, because there are real services behind it, that Y has to pay to X, or has to pay to some other member of the group for services performed. Well, to the extent that we can have expenses, legitimate expenses in here within Y, again, that reduces the tax base. And that's generally referred to as base erosion. Base erosion. You are eroding, you're reducing the tax base by expenditures or depreciation, interest expense, or royalties, or whatever it happens to be that you can legitimately structure. Now, later in the future, when we get to tax treaties and we talk about in more detail the limitation on benefits article, you'll see that there's a base erosion test that are typically included in those limitation on benefit articles. But this is a mechanism that is commonly used in trying to minimize tax within the intermediary company. I've got a few slides in here which I will suggest that you read and look through. And what they try to do is make suggestions as to how to put more substance into an intermediary company so that it can be more readily accepted and respected. And also something about the mechanisms that the tax authorities in various countries can use to attack these things. So please take a look through these on your own. And again, please let me know if you have any questions. We'll do this Indo-Foods case, and then we'll go into the ABC case study discussion. You received, I believe, last week, a sheet of paper. Hopefully you read the front side, and perhaps even read the back side as well. This is a particularly interesting case, and it shows a very common use of an intermediary company. And it also shows in living color the kinds of concerns that can arise, both from the standpoint that things change, countries can change their attitudes, countries can unilaterally get rid of a tax treaty. And it shows that courts can have varying opinions on things. So it's got a lot of interesting aspects to it. So let's start out by looking at the three parties that are up here. We have the Indonesian parent company, which was Indo-Foods, real company. And it's a major company in Indonesia. It has major food operations and other operations. And it needed capital. Now, around the world, a lot of large corporate groups seek money in the capital markets. They want to borrow millions and millions of dollars. So, since there are not a lot of domestic Indonesian investors who would want to loan money to Indo-Foods, they're looking for funds from outside Indonesia in the capital markets where the investment banks sell bonds and notes and other obligations of large corporate groups. Now, Indonesia has an interest withholding tax. That interest withholding tax is 20%. Now, if you're going to lend me money, and you're, from some country around the world, do you really want to know and care about how much withholding tax there is? Now, here in this audience, I expect you to, of course, say yes, because I get a foreign tax credit. But a lot of the investors for these things are either institutions, which by their nature are tax exempt, or individuals from countries where either there is no tax on foreign income, or they are just hiding the income and not paying tax on it. So as a result, this market is based not on what's the total interest income and we as the investor take responsibility for the income tax, the withholding. Rather, this market is based on, tell me what my net is, and I'll decide to invest or I will not. And contractually, the obligor, ultimately the Indonesian company, is saying, okay, I accept that you are lending to me on these terms. I will guarantee you, for example, a 5% return. Now, the actual legal amount of interest might be 6, and there's a withholding of 1, and I pay you a net of 5, and if the withholding rate goes up so that, well, gee, in order to give you 5, I now have to pay 7 because I have to pay 2 to the government instead of 1. So I still am giving you a net of 5. Well, that's my obligation. That's the Indonesian company's obligation, because it's agreeing to pay a net amount of interest, not a gross amount where the recipient economically takes the risk of whatever tax there is, whatever withholding tax there is. So as a result, if there's a domestic 20% withholding rate in Indonesia, and Indo-Foods is going to borrow several $100 million, if they can reduce that 20% withholding down to 10%, that's a big savings to them. So, as a lot of companies do, they said, well, gee, we won't borrow it directly from all of these non-treaty protected investors. Rather, what we will do is we will set up a company in Mauritius which has a tax treaty with Indonesia. And under that tax treaty, the withholding tax on interest is reduced to 10%. So that's a wonderful answer. It reduces the amount. At the time, the Indonesian government was very happy with those sorts of things, didn't question these types of things. And as a result of this, structurally, this Mauritius company becomes the issuer of the notes. And people in the international capital markets, investors, they buy those notes from this company, the Mauritius company, and there's then a back-to-back loan with exactly the same terms between Indo-Foods, the parent, and Mauritius. So that when interest is paid, it's paid from the parent company to Mauritius, and then either the same day or I think the next day, the payments of interest go out to all the note holders. So, perfectly normal financial structure that's used many, many times in many countries around the world. The Indonesian government started to worry about treaty shopping. And somebody, of course, in the government said, you know, why do we have a tax treaty with Mauritius? All it is a mechanism for treaty shopping. So, as of, I think, January 1st, 2005, the treaty between Indonesia and Mauritius was terminated. And that meant that as of the next day, in other words, there's no grandfather rule, as of the next day, a 20% withholding tax will apply instead of 10%. And that means that, not using exact numbers obviously, but if the gross interest that the Indonesian company was paying to Mauritius, if the gross interest before withholding was 110, to get a net payment of 100 to the note holders eventually, then all of a sudden the gross interest would have to go to 120. Now, the plot thickens, so to speak, because there's ulterior motives. In, I think, 2002, give or take a little bit, this was the, I think 2002 roughly was when these notes were sold. Now, I think you're aware that interest rates go up and down. Currencies go up and down with regard to value. So, between 2002 and presumably, I think, 2004, when this was being looked at and negotiated between the parties, the interest rate had fluctuated so that now, if the Indonesian company could pay off these notes, they could reborrow at a lower interest rate. And there was also a benefit because of movements in the currency levels. So our friends in the Indonesian company, they actually saw this as being a wonderful thing. It gave them an excuse under the loan documents that if there is a major change in taxation, they have the right to prepay the notes without penalty. So they're extremely happy. We can pay this off early and refinance at a lower rate. On the other hand, the note holders who had bought notes for some number of years and were hoping for what had been, the market rate at the time they bought, but now is a higher than market rate, they want to continue earning that. So they want to keep receiving their high rate of interest, because if they have to surrender their notes and receive the principal without any extra amount, they can only reinvest at a lower interest rate. So you've got an economic issue here between two private parties. One party being ultimately the Indonesian company, and the other party being all of the note holders who were represented by a bank trustee that was acting on their behalf. So our friends at the Indonesian company, they're saying, gee, I have this extra tax, I have to pay off the notes early. Sorry. And the bank trustee, on behalf of the note holders, is saying, forget it. You can't pay it off. You can easily just substitute instead of using a Mauritius company, which is no longer any good, just put a Dutch company there. There's still a valid Dutch-Indonesian tax treaty with a 10% withholding. It's easy. Everybody does it every day. What are you concerned about? So you've got this economic issue which is being argued over a tax issue. This dispute ended up going to court in England. And the judge, to make a longer story a little bit shorter, the judge basically looked at this situation and recognized that it had to be decided, not on the economic concerns of the parties, but on taxation issues. So the question was, that the court looked at, whether this is Mauritius or a new Dutch company, which would be inserted according to the bank trustee. The court looked at, was this issuer, was it legitimately able to take the benefit of a tax treaty between Indonesia and the country of residence of this intermediary company? Now, the court basically looked at this and made a couple of points. One point was that under the treaty, again, whether it's Mauritius or whether it's the Netherlands, that issuer has to be a beneficial owner. As the treaty says, that if you look at Article 11, 12, and 13, or 10, 11, and 12, I should say, dividends, interest, and royalty, in most treaties, it says it's only available, the lower withholding rate, if the recipient is the beneficial owner. And the court, without a heck of a lot of difficulty, said, hey, what comes in goes out. This one does not control anything that's there. It's really just a conduit. It really doesn't have beneficial ownership of its own income. So that was one thing that it said. Another thing it said was that this one is not going to do anything that is not actually decided back in Indonesia. And therefore, this issuer is not even resident in the treaty country. It's not even resident in Mauritius or potentially the Netherlands. And as a result of those findings, they, of course, decided the case that the bank trustee was wrong. The Indonesian company could not simply change what the country of incorporation of the issuer was and continue with the 10% withholding. Now, in this case, I think Indo-Foods maybe played dirty, so to speak. One of their witnesses, I understand, was the Indonesian tax authorities, who said, of course, this is terrible, this is treaty shopping, we would never allow it. You can understand that the factual background of this was not strong, and the court, looking at this for a commercial dispute, said, hey, they're not authorized, they're not allowed to take a treaty benefit, and therefore the Indonesian parent will have to pay 20% in the future, and under the terms of the notes, that allows them to prepay early, case closed. Now, this initially, when it was decided, gave a tremendous amount of fright, so to speak, to the financial markets, because this kind of thing is used so often. And I don't know how many countries did this, but I remember that the UK tax authorities actually came out with a release saying, you know, hey, everybody should be calm, we're not going to attack these kinds of structures because of this case. But the point is that more and more countries are thinking about this. Again, we're looking at a moving target. Let's now talk about some about the ABC case study. Now, I presume you probably have on your computers, or available on your computers, the item which I sent you. And what I'd like to do is try to walk through as much of it as we can, and talk about what's in there and where some of the things might be important. Because again, remember I said that clients tell you a lot of things that might be important to you, some that might not be. Another thing is that throughout here, you'll see where it says the client's interested in hearing about this. Now, I recognize that this kind of case study is very, very wide-ranging in terms of its potential coverage, and that despite that wide-ranging nature, that all of you probably have limited time, and also interest in certain areas and maybe less interest in other areas. Now, recognizing that, although it says in here in various places, gee, the client would be interested in this particular aspect or that particular aspect, I'm very happy for you to choose some of those items. You know, don't feel forced to try to react to all of them, but at least pick a few where you say to yourself, gee, that's interesting to me. And learn more about those areas and include that in your assignment 3 and or assignment 4 as appropriate. So starting on the first page, one important item there in the second paragraph of item 1, it says, Mark has informed you that your work product will be provided to all members of the task force, all of whom will be required to read and understand its significance. One of the most important things is to know your audience. Now, whether it's me talking to you and asking all of you to give me a little background on who you are and what you're interested in, or whether it's you as a professional dealing with your client, who is your audience when you write something or when you get up and make a presentation? So that's important. There's a task force of people from a number of areas of the business. And your audience is very broad. So that's something that's important. Okay, on page 2, we see that ABC is publicly held in the U.S. And we see that there are no large shareholders and an insignificant number of non-U.S. shareholders. So that gives you some information that's important. You know, we've talked about before that, you know, it's a terrible idea to have a foreign parent company in the U.S. and that company invests overseas. That's terrible. You wouldn't want to do it that way. So this tells you that, well, we're not looking at a situation where that kind of concern is relevant. Because this is a U.S. parent company that has nobody over it that is either outside the U.S. and certainly nobody else that controls it. Management and the board of directors are firmly in control, and this is a U.S.-based multinational, or well, maybe not so multinational, because we say there's only I think two foreign subsidiaries in Europe, so maybe it's a stretch to call it multinational, but maybe it will be someday. Now, we also say in the second paragraph of item 3 that the consolidated balance sheet shows $10 billion of gross assets, $5 billion of liabilities, and $5 billion of shareholder equity. So that tells us that we have generally a 1-to-1 debt-equity ratio. Now, that's looking at it on a consolidated basis. Any particular company within the group might have a very different story on a separate company basis. So understand there can be differences, but where there's something that you can look at on an overall basis and say, okay, I understand in general about the company as in a large sense, that's important background. Well, why is it important? Well, for example, maybe you're going to be capitalizing a subsidiary in your country of choice for the manufacturing facility, and you find when you look that local thin capitalization rules also refer to, the fact that they will take into account the debt equity ratio of the parent company back in the U.S. or the group as a whole. Maybe they will bring that out as being one of the factors which they will use in deciding whether there's a thin capitalization problem or not. And it allows you a little bit more knowledge and background in dealing with those rules as you try to create a structure. Now, on the top of page 3, it says NutriPower products and a number of other food and non-food products are operated as autonomous divisions of ABC Inc. Now that means that there is that within the parent company there are a number of operating divisions which are not separate legal entities. NutraSweet is not operated as a separate subsidiary that has its own legal existence. It's just legally and physically a part of ABC Inc. On page 4, at the top it talks about the fact that there's an excess foreign tax credit provision. I'm sorry, there's excess foreign tax position. Foreign tax credit position. And down in number 8, it says that each year some amount of foreign tax credits are expiring. And that means that ABC, all things considered, will be better off if you come up with a structure that pays, relatively speaking, less foreign tax than more foreign tax. If the background were that they had plenty of foreign tax credit limitation and really didn't have any problem using foreign tax credits, then it would be the opposite, that, well, we don't want to gratuitously pay foreign taxes, but we shouldn't go out of our way to save foreign taxes, because there are going to be credits anyway. And later on in here somewhere, as I recall, it indicates that that there are plans to regularly pay dividends and not amass large amounts of low-taxed income outside of the United States. So there's not a big timing of, time value of money issue here. Now, in number 8 there, in the first paragraph under number 8, it mentions that ABC Inc. is earning royalty and rental income from intellectual property and machinery that it licenses or leases to unrelated European food processors, and that the equipment and IP is of the same type as will be used in the processing of NutriPower products. Now, this is telling you that there are actual third-party, comparable, uncontrolled prices that can be used as a basis for intercompany pricing later in assignment 4. So that's rather important information that will help minimize transfer pricing concerns. ABC files a consolidated U.S. tax return. Okay, so that's some background information for you. If we set up a company in your chosen country, will it be part of the U.S. consolidated tax return, or will it not be part of that? I don't know what you've studied with regard to the consolidation rules. Any ideas? Let's say that this is the U.S., and let's say this is Hong Kong, and the ownership is 100%. And let's say that if this is ABC, let's say your assignment 4 company is this Hong Kong company. So the question is, we're saying ABC and is filing a consolidated U.S. tax return. Does that consolidation, which will show the P&L of each company, add them up, come to a taxable income, and subject it to U.S. tax, will that tax return include the Hong Kong company? Now, don't think about, well, gee, I haven't read that rule before. Think about what we've talked about with respect to jurisdiction, the fact that the U.S. has CFC rules. Can you guess what the answer might be?
Yes.
Yes, what?
Yes, I think it has to be.
Well, so much for my expectation. But no, thank you for throwing it out. Now, let me ask though, why did you answer yes? What's the logic that you used?
Well, if the U.S. likes to have income of 50% more companies impose a dividend, then it seems like if it's 100% of its hard, you're looking at the entire group, that's obviously part of the group, it's 100% by it. So it seems like
Okay, no, that's good logic, but sadly it's incorrect in this. Well, I like to use more politically correct language, but in any case, the point is that using my sense of logic, if we have from a jurisdictional standpoint, we have a worldwide tax system on companies incorporated in the U.S., but no U.S. taxation, because there's no jurisdiction, of a company incorporated outside the United States, and ignoring for a moment whether that company, in this case the Hong Kong company, is doing business in the United States or any of those various things we talked about when we went through one of the case studies before. The Hong Kong company, although 100% owned, is a separate legal entity which is not part of the U.S. affiliated group. If you look at your consolidated return code sections, you'll see that what's included in a consolidated return is the affiliated group of companies. And that only includes U.S. companies and some very rare exceptions, which are primarily, I think, Canadian or Mexican companies that are there just to hold real estate. Now, things may have changed in a lot of years, but I kind of doubt that that one has changed. So the consolidation, which includes all affiliated group members, will not include the assignment for Hong Kong company that you set up. And of course, if that company is earning income which is hit by subpart F, the CFC rules, then of course the income might be taxable to the parent, but you will not be including all items of income and expense in the consolidated return. Okay, at the bottom paragraph of page 5 talks about the neutral power division's operating ratios. And it says, it gives a number of things. Income, or let's say revenue, cost of goods manufactured, and it says that if the revenue is 100, the cost of goods manufactured is 40, giving a gross income figure of 60. Now that's a very high margin. You don't find necessarily all that many companies with this kind of high margin. It reflects the value of that secret formula for their product, which is allowing sales at a premium price. So this is something which is consistent with the fact that, well, maybe there's something of value there. And it also says that salaries are 10, advertising is 15, R&D is 5, and other is 5, giving a total of 35, meaning 60 minus 35 is 25, net income of 25. Now, in assignment 4, you're going to be looking at a manufacturing facility in the other country. So an interesting question is, if this is the situation for this 750-man division in California, and the 100 salespeople who are around the United States, what might you want to see in your country of choice, country that you choose for assignment 4? What might you want to see? Well, if your particular country that you chose, remember, you're choosing the country, I hope, because of personal interest, not because it has a high tax rate or it has a tax holiday or something. You're choosing it because you have some personal interest in it. So you just have to accept whatever's there in terms of rules, in terms of environment. So if your country happens to be a very high tax country, you might be thinking about trying to structure things so, to the extent possible, you minimize this number. On the other hand, if your country of choice has a lengthy tax holiday, you might say, well, the facts have told me that the company really wants to dividend back profits pretty regularly, but, you know, hey, things change. The board of directors and management that says, gee, we want a flow of cash today, might tomorrow change their minds. And it's easier to not have to change your structure later because their objectives have changed. Better you have it, to the extent you can, the way they might go if they change their minds. So if there were a lengthy tax holiday, you might want to maximize what's here. Now, if we look at this thing, this is the U.S. side, California, the salespeople. This one up here, the cost of manufacturing, that would include, for example, salaries of the production staff, whereas the salaries down here would be the salespeople, administrative people, and so on. Now, looking at this thing, some of the information that's in there tells you that ABC owns, because they're in a non-food manufacturing business, and they, in fact, manufacture equipment which makes food, and they have patents over it. They're going to manufacture this equipment themselves, in-house. They don't have to pay license fees or royalties to anybody else for the technology which goes into this. So, as a result, this cost of goods manufactured of 40 is really artificially low, because economically there's a cost of technology, but it's not showing in here. Now the point here is that when you now set up something where you have the Hong Kong company over here, which is a separate legal entity that's going to use the equipment that has been manufactured by ABC Inc., you can reflect the real economic cost of that equipment that, in fact, includes the value of the patents and know-how that goes into building that equipment. Okay, well, thank you very much. Good night.